Preview.
When we see clients, when Jason, when you see clients that have bought a business, oftentimes we'll see and we'll hear about rollover equity, where somebody has bought up they've sold their business and they've rolled equity over. What does rollover equity mean?
So when you're selling a business to a potential buyer, most of the time, especially in private equity transactions or even strategics, you're not free and clear. There's some skin in the game that the buyer wants you to stay on and continue on with the business, or at least have some financial interest in the business going forward. And so rollover equity is saying, say, 20% of the equity that I had before is now going to be rolled over into the ongoing business going forward. And so if there's another transaction or another sale in the future, I could benefit from the additional upside. At the same time, I'm not selling 100% of my stake, so that way I have a vested interest to not just plump the business up for that 2 to 3 years we talked about and then run, right? I'm going to try to make this a sustainable business going forward, having that story, having those financials, having the good operations as well, not just a pump and run. So it's very common to show that some portion, maybe around 20% of your business will be rolled over, and that incentivizes you as well to share in the upside in the future.
I've also had clients that have sold businesses, and while a portion of their business will be rolled over into the new entity, what oftentimes comes up in negotiations as well are earnouts. Can you describe a little bit about, what are earnouts?
So earnouts, another name for that is contingent consideration. So that's where you and a buyer may not agree on the exact purchase price. So instead of $100 in cash for my business, you think it's worth 120. Maybe the buyer thinks it's worth 80. But you guys don't know, and you want to prove him or her right. So an earnout would be saying that I'm going to defer part of the purchase price for some additional upside. So if you're meeting certain financial or non-financial milestones in the future, you may get paid additional amount. For example, over 3 years, if you can hit certain revenue targets, you'll get paid certain dollar amounts, say in cash, or potentially shares in the future for that. So that's a way for you also to continue on with the business, to at least prove that the business is operating as you believe, and to achieve those financial or non-financial metrics. And then again, to share in the financial upside too. From a buyer's perspective, it's aligns incentives quite well. It gets those buyers to want to achieve those metrics, and oftentimes those metrics are set up so that the buyer also benefits equally as well.
So I can see it can be beneficial to buyers. What ramifications should buyers be aware of when working earnouts into their negotiations? And specifically, from my understanding is when a buyer buys a business and there's an earnout, the buyer has to put the assets typically that it's acquired on its balance sheet at what we call fair value, and earnouts can be a little bit tricky. So when the buyer's going through that exercise, how do they value those earnouts to make sure that the consideration is appropriate for their purchase price allocation and to mark those assets that they purchased at fair value?
So you're right. The earnout does need to be valued day one, meaning at the time of the transaction. And so let's just give a quick example. Let's say you as a seller are entitled to an extra $20 over 3 years if you achieve certain revenue targets from the business that you're selling. But in reality, the fair value of that earnout would be likely something less. There's present valuing effects of it. There's also the likelihood that you may or may not achieve that whole revenue targets over those 3 years. So that earnout would need to be fair valued. How it's fair valued could be either some probability weighted analysis, or it could be using something more sophisticated like an option pricing technique. Oftentimes we see something called a Monte Carlo simulation, which looks at a trial of 100,000 potential simulations over that, say, 3-year time frame, and averages the outcomes based on a distribution and certain key inputs. So it's a complicated model. The whole point is that earnout could be valued, say, at $6 on day one, and that's what needs to be recorded for your purchase price allocation. Obviously, when you achieve those revenue targets, you'll recognize up to the $20 if you can achieve the revenue targets. But there is a complicated, sort of process to do that, and it is something to really think about when you're doing your accounting, as well as kind of measuring incentives on day one.